There's been no honeymoon for the new Labour government. Since the July election, UK economic growth has continued its long-term trend of barely existing. Recent data disappointed analysts, with output falling in the past 2 months. Monthly data is a bit noisy, but it comes amidst businesses warning of a weaker labour market, with higher national insurance and rising labour costs leading to a rise in job vacancies. Now, the weaker growth has been attributed to concerns about the budget. It wasn't helped by all the talk of budget black holes and the need to make painful choices. It's not surprising perhaps business and households are somewhat gloomy. Now, it is too early to talk about a recession, but despite higher government spending, the OECD reduced its forecast for growth next year from 1.1 to just 0.9%. Rachel Reeves is finding that wanting economic growth and achieving economic growth can be two separate things. But beneath the surface of stagnant economic growth, there are several worrying factors which make the hope of a strong economic recovery look increasingly pessimistic. Firstly, GDP stats are massaged by some extent by the rising population, mostly due to high net migration. Real GDP per capita has barely increased since 2007, and it's still below its 2019 peak. Secondly, if we delve below the overall GDP stats, we can see that some industries are in clear decline. It doesn't get much media coverage, but the UK chemical industry is one of the UK's top manufacturing exporters, with 29 billion of exports last year. In 2021, it employed 250,000 people and had revenues of 75 billion. But since 2021, output has fallen about 37%. Industrial and manufacturing output is also falling. It's a new era of deindustrialisation. The difficulties of the steel and car industries are well documented. In 2017, the car industry was producing around 6 million cars. Now it's nearly half that peak. This decline in manufacturing makes the UK economy increasingly reliant on financial services, and London in particular. But if anything, the UK's over-reliance on London and finance is more of a problem than a benefit. In recent years, the FT report how the UK has become even more London-centric. 30 years ago, half of the top-paying jobs were in London. Now it's 75%. The UK is the only Western G7 country where jobs are becoming increasingly concentrated in the dominant region. Most graduate jobs are still in London, but with rising rents, many have been priced out and firms find it difficult to get key workers. In the US and Europe, high-paid workers have other alternatives from the capital city, but the London economy continues to dwarf that of the rest of the UK economy. Now, recently, Rachel Reeves was in Brussels asking for special treatment for the City of London, a strategy which, given all the past Brexit history, is unlikely to get much of an enthusiastic response from the EU. But because of all the desperation for higher economic growth, the Chancellor is looking to relax regulations on city firms to enable them to be able to take more risks. She's saying that the regulations after the credit crisis went too far. But the last time a Labour Chancellor took a light-touch approach to financial regulation, it didn't end well. Big taxpayer bailout. The UK really does depend on London city jobs for a lot of income tax revenue. The top 1% of earners are paying around 29% of total income tax revenue. But relying ever more for finance sector to achieve economic growth has many drawbacks. The IMF produced a report that warned a large financial sector can have a negative impact on the economy when private credit is greater than 100% of GDP. In the UK, private credit is 160% of GDP. But only 18% of this bank lending is going to productive industries. Most of it is in the form of mortgages, lending to the finance sector. A lot of lending pushing up asset prices rather than leading to valuable investment. And this is actually a concern about the economy, a decline in investment in recent years. The UK, one of the worst investment performances in the G7. A more promising approach the government have mentioned is perhaps trying to encourage UK pension funds to invest more in the UK rather than moving money overseas. That may help. Also, regional banks focused on lending to business and infrastructure would be welcome if they can get it off the ground. Now, one factor behind the UK's industrial decline is one of the most expensive electricity prices in Europe. Modern industry heavily reliant on electricity. Modern steel factories no longer burn coal but use electricity. Massive data centres rely on very reliable energy sources. Now, the government has an ambitious plan to invest in renewable energy sources. But even if successful, years of underinvestment in the national grid means it will be difficult to connect where it's needed. And you do need more than renewables as well to provide that stability of energy. The second big underlying problem in the UK economy is the backbone of any economy, which is labour productivity. And this is a bit of a well-known story. Up until 2007, it was growing by around 2% a year, but since that crisis, it's gone to around just 0.5% growth. And if this doesn't improve, UK growth will always be constrained, because even if you boost demand by cutting taxes or higher spending, if productivity doesn't rise, then higher demand just causes inflation. Even now, with pretty low growth, inflation is stickier than many policymakers would like. There's a nervousness about cutting rates when the majority of goods are still rising faster than 2%. In 2025, many homeowners who are still on good 5-year fixed deals will face much higher mortgage costs when they have to remortgage. Renters face little let-up in the cost of living, with rents having risen 25% since 2021. And this is a really big problem, because even if the economy manages to grow a little bit and real incomes rise, they tend to be eaten into by housing costs. The Joseph Rowntree Foundation says that adjusted for housing costs, average household incomes could be £700 less than 2019, £700 less than 2024 by 2029. Now, the OBR is the most optimistic forecaster for the UK, with economic growth penciled in of 2% for 2025. However, whilst respectable, once we take into account population growth and housing costs, there's still not much improvement in living standards. The third problem is a lot of the government's programme and policies are based on achieving economic growth. And if growth doesn't materialise, it would create a really negative feedback loop. They need higher growth to fund public services, and if growth doesn't come, we may need to either increase taxes or cut spending in 2 or 3 years' time. More difficult choices down the road. And the underlying problem the UK, like many countries have, is this demographic change, which is going to be a big factor in the coming years. We've got an ageing population, so more spending on pensions and healthcare. And that's just to stay on top of the ageing population, let alone get to grips with things like higher waiting lists and better preventative health measures to try to improve the nation's health. And that brings us to another long-term problem: rising sickness rates and increased economic inactivity. People leaving the labour market is a big problem, because despite this recent slowdown in the labour market, firms still struggle to fill vacancies in certain sectors. Good example, the government want to build 1.5 million new homes. A good way to try to address some of the shortage of housing, but do we have enough workers to be able to build them? And if that all sounds pretty grim, the global outlook doesn't particularly offer any comfort either. If anything, very weak growth in Europe won't help, and the US looks like they could be introducing higher tariffs, which could reduce global trade. So if anything, global factors will do more to hurt rather than help the UK economy. At least oil prices are low, but any new oil price shock would be a real problem. However, as you know, at Economics Help, we always try to look on the brighter side of life. Are there any optimistic shoots of recovery we can hang on to? Well, firstly, although growth is very weak, it is too early to talk of recession. Growth of 1 to 2% next year would be something. It's better than nothing. And if there is growth, it may start to encourage a bit higher confidence, encourage people to spend and invest. As I've said a few times, an interesting feature is that underneath all these gloomy figures, households are actually increasing their savings really quite a lot. So in theory, some households at least do have more money that they're able to spend. Thirdly, last year was another record year for reducing battery costs and the costs of solar panels and renewable energy like that. Batteries are increasingly important for goods, transport and industrial production. Technological improvements have been consistently better than many people expect, and they're likely to keep going in the future. Solar, batteries, renewable energy, all getting cheaper and will continue to do so. Now this is the kind of thing that really can increase productivity, whatever happens to a government. Now of course, the benefits of this are slightly reduced in the fact we're not really making these technologies, we're importing it from China. But it still will help a little bit, at least it will offset some of the expected rise in food prices we might see in the next few years. Fourthly, rising labour costs may actually provide a stimulus for firms to invest in labour productivity. If labour is more expensive, maybe it'll encourage firms to try to increase labour productivity. It's one theory anyway. Fifthly, is all the gloom around the economy somewhat exaggerated? Unemployment is low. Growth should be at least positive next year, thanks to the minimum wage. Low-paid workers should see some more real wage rises. The media and YouTube does have an incentive to exaggerate negative stories. You get the feeling that some media are enjoying blaming the Labour government for everything. So, not helped, I should say, by the government themselves kind of saying how bad things are. But maybe next year they'll get into a more positive spin, at least try. Now, I'm not sure how convincing that optimistic spin is. I think the basic premise of a virtually stagnant economy does still just about hold. Very low growth is not enough to lead to a material increase in living standards, especially because the housing crisis sees no sign of abating. And the big question is, will house prices continue to rise next year? Or is there a chance they could actually start to fall? This video looked at the prospects for house prices in 2025.